Thank you for joining today's webinar on the financial system and corporate governance impacts of passive management. My name is Hank Kim, and I'm the Executive Director and Counsel for the National Conference on Public Employee Retirement Systems. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. The rapid rise of investors' use of low-cost equity indexing is helping investors implement increasingly cost-effective investment programs. However, asset flows to passive management are raising questions about potential impacts on the U.S. financial system and the corporate governance movement. In today's webinar, we will review the implications for public pension funds and other institutional investors. Our presenters today are Maureen O'Brien, Vice President with Segal Marco Advisors, and Julian Regan, Senior Vice President with Segal Marco Advisors. We encourage audience participation. Please submit questions by using the GoToMeetings portal. However, to ensure that we can cover all our topics, we will hold your questions till the last part of the program. Julian, Maureen, I'll turn the webinar over to you.
Thank you very much, Hank. If we go to slide 2, this presentation really is about the new reality of today's stock market. And it's a reality where 30%, perhaps 40% of U.S. equities are now invested passively, that is indexed, as compared to 3 or 4 decades ago when all assets were managed actively. And as much as indexing has helped public pension funds and other institutional investors and continues to help investors implement cost-effective investment programs, the magnitude of this shift is starting to raise questions about impacts, as Hank said in the opening, on corporate governance, on market volatility, and also on the concept of price discovery that we will elaborate on momentarily. Just going to the next slide. Of course, for this group, on slide 3, I'm assuming that definitions probably aren't necessary, but just to provide some background, active equity management, and we're really going to focus on equities and not fixed income. Active equity management is, of course, a strategy that involves the investment manager trying to beat a benchmark index, construct a portfolio of stocks that might be a subset of an index, let's say 80 stocks within the S&P 500 index, with a goal, of course, of beating the index's performance net of fees over the long term, whereas passive management, which is much lower cost, is a strategy that entails the investment manager constructing a portfolio that really in the equity markets looks precisely like the index. All 500 stocks of the index are in an S&P 500 index fund. Those stocks' weights look exactly like their weights in the index, and of course the goal for an index fund manager is to keep costs low and to match the performance of the index. In the bond markets, a term called replication describes how fixed income indexing is used, but really we're focused again on equity market indexing. Just turning to slide 4. Again, this presentation, as summarized on slide 4, is not a debate on whether or not active or passive management makes more sense. Quite frankly, for institutional investors, typically active and passive management have their roles in an institutional portfolio. But again, on slide 4, next slide, the presentation is about the potential impact on markets, particularly, and Maureen will elaborate on this in a little bit, where we have 3 investment management firms, all good firms, but 3 investment management firms who control 80% to 90% of the index fund market, and as a consequence of that, have a larger and larger share of corporate America under their control. Slide 5 is some arguments that passive managers make that kind of push back on the notion that there should be some concern on the systemic impacts. Maureen is going to speak to this.
Thanks, Julian. So as this concentration moves from active to passive management, there have been concerns raised, as Julian mentioned, and the passive management community has responded with their own counter-arguments to the concerns. One is that the number of assets that are invested with passive management aren't as large as some studies would indicate. BlackRock put out a study in October that showed a estimate that it's 12 trillion assets under passive management, which is much lower than some of the other figures that you'll see throughout this presentation. Another argument is that active managers will continue to exist and they will continue to select stocks based on price discovery, and so passive management doesn't preclude those active managers from making those opportunities to select stocks based on price discovery. Another argument that passive managers make is that because they hold the market for the length of their investment as passive managers, they have an inherent interest in being good capital stewards of those companies.
Okay, next slide. So if we step back for a second and on slide 6, look at the U.S. equity markets, one, I think, very sobering and impressive fact, and it's a fact that NCPERS has spent a lot of time maximizing the value of, is that public pension funds, actually when combined with private pension funds, own about 17% of the U.S. equity market. If you want to round up, that means defined benefit funds own almost 1/5 of publicly traded companies in America. And public pension funds themselves, as the table at the top of page 6 shows, own about 9%, at least based on data from the Federal Reserve. So obviously, investing in equities, fixed income, and alternative investments is a concern to public sector board members for their particular retirement systems, but the performance and behavior of our markets and the performance and behavior of corporate America is of critical concern to public fund investors. A pretty good quote at the bottom of page 6 from Gary Cohn, the ex-White House economic advisor, making the point that the folks who own the stock market, the people who own the stock market, really are policemen, firefighters and teachers and other civil servants whose public pension fund boards invest for their benefit. Let's go on to slide 7. We know that according to most studies as shown on slide 7, approximately 48 to 50% of public fund assets are invested in equities. Most, not all, but most of these investments are made in U.S. equities, and most public pension funds and most institutional investors in today's world typically use a combination of both active management and passive management to implement that 48%, just rounding up and using the average equity allocation from Exhibit 2 on the upper right-hand side. Oftentimes, the decision to invest passively will be determined by the market. Passive management is much more prevalent in more efficient markets, large cap stocks, for example, where active management has been more challenged to beat indexes. Passive management more frequently utilized in less efficient markets, small cap stocks, for example, where the historical track record of active management relative to indexes, according to most data, has been better performance. So if we just go to slide 8, to make another point, the flows of assets from actively managed strategies, again, strategies where the investment manager is trying to beat the benchmark index, to passively managed or index strategies have really been exacerbated in the wake of the financial system crisis. We'll look at some data in a minute to kind of put that, to drive that point home. But just to lay a little bit more of a foundation on the distinctions between active and passive management, if you look at the top half of page 8 here, you can see for investors who are hoping to beat the benchmark index, let's say the S&P 500 index of large cap stocks, for investors who have some tolerance for variability in the return stream of the portfolio relative to the index, active management is going to be more appealing, at the risk of oversimplifying. For investors who have no tolerance for the return stream varying relative to the return stream of the index, and who are focused on cost effectiveness, which is a big benefit of passive management. Passive management makes sense. There was a recent study put out in the spring of this year that reported, it really estimated, that global public pension funds That is pension funds in the U.S. as well as the non-U.S. Markets. Over half of public pension funds allocate about 40% of their equity portfolios, 40% of that 48% we looked at a minute ago, to passive strategies. Just go to slide 9. We can see that the flows from active management to passive management really have been headline news, and the numbers are arguably staggering. Just a snapshot is shown in the upper right-hand side of page 9. You can see in this exhibit, in 2016 alone, an estimated $400 billion of assets was taken out of active equity mutual funds. Now, that doesn't count separate accounts or commingled funds. And almost $500 billion. If you add up the numbers on the right-hand side, $486 billion was allocated to traditional index funds and index fund ETFs. Now, just a point on index fund ETFs. This presentation is not about exchange-traded funds, but with exchange-traded funds, which trade intraday and have other characteristics that are different from typical separate accounts or commingled funds or mutual funds, with a larger and larger share of indexed assets going to ETFs, and with ETF investors in some cases using ETFs for short-term trading, there's rising concern that indirectly the flow of assets to index funds will have the potential to make our markets more volatile. We'll point to a statistic that provides some evidence of that a little later on. You can see at the bottom of this page, page 9, a quote from John Bogle. John Bogle is really the founder of indexing, and even he is pointing out that there's some concern about the impact of index ETFs on the behavior of our markets. Go to page 10. I believe Maureen was going to speak to the shift in the market share of passive versus active management.
Great. So as Julian outlined, there's a lot of cost savings to be had in passive management, and particularly after the financial crisis, investors saw that as an advantage over hiring active managers. The New Yorker did a piece a couple of years ago that asked the intriguing question of maybe we wouldn't be so shocked to see that all of this too good to be true option maybe isn't as good as it seems. So we'll talk more about the risks and the changes to the market that have come out of this. But just to give you an idea of the scope, the number of assets moving into passive management grew from 55 billion to 4 trillion with a T. That's over a 10-year period. So this is an aggressive swing, and it looks like that trend line will continue to rise at that same rate. Moody's did a study that showed that the number of assets that are passively managed is going to exceed those assets that are actively managed when we reach 2024.
And just to make a point on slide 11, before I speak to one of these exhibits, this presentation is not about challenging the notion of passive management. NCPERS in their 2017 study documented the fact that public pension funds run cost-effective investment programs. I believe the annual asset-weighted expense that public pension funds who were surveyed by NCPERS to run their retirement systems was 56 basis points. That's less than 0.6%. The reason I bring that up is part of the reason that public funds have been so cost effective is because of indexing. So at the local boardroom level, indexing has been an excellent tool to gain exposure to equity markets, in some cases fixed income markets, and to bring costs down. Really, again, we're focused on the broader implications for our financial system. If you look at the upper left-hand side, the challenges that active equity managers, that is managers who select stocks to try and beat the index, have faced in beating their indexes have been pretty well chronicled in the recent past, in the wake of the financial system crisis in particular, and have been, of course, one of the reasons for the shift from active to passive management that Maureen spoke to. One data set on the upper left-hand side from Standard & Poor's shows us that for the 5 years ended December 2017, 84% or more of active equity mutual fund managers, this is just a subset of managers, but still instructive, 84% or more underperform their index. Now, to balance this point out, there's some good research that's been produced, most recently, at least in my experience, by Morningstar in February of 2018, that makes the point that active management typically does better in down markets. So just to highlight the upper right-hand side of page 11, you can see Morningstar found that over a 20-year period ended in January of 2018, 60% of active managers beat their benchmark index. So plenty of active managers, and for some good reason, will make the point that the challenges they've faced recently have been due in part to the fact that we've had overwhelmingly rising markets in the wake of the financial system crisis. If I go to slide 12, another point to be made is around cost. On slide 12, we see the results of a survey a CFA publication did of its members to ask them what are the top reasons for active manager underperformance. And no surprise at all. You can see the number that's circled. 24% of respondents stated that higher fees of active management are the biggest impediment to active managers beating the benchmark index. If you think about it, when you compound the cost of active versus passive management, it does create a hurdle. But there's some other reasons that are worth thinking about. We think about the recent history of active and passive management that has influenced performance. In addition to fees, plenty of market experts point out that our capital markets, particularly large cap stocks, are becoming increasingly efficient, making it very difficult to gain any information advantage in selecting stocks. Information advantage is the stock and trade, or a stock and trade for active equity managers. In addition, in the wake of the crisis, we've seen stock prices move in tandem with one another, oftentimes on the basis of macroeconomic news, for instance, from the Fed several years ago about quantitative easing. So you would see a General Motors and a Ford company stock move up and down together. That makes it tough for an active equity manager to beat their benchmark index. There's some other reasons as well cited in the survey. If we go to slide 13, talked about historical performance as being one of the drivers of the market flows from active to passive management, but the upper half of page 13 gives a pretty good example of the cost differential between active and passive management. For mutual funds, the average cost of an active equity mutual fund, about 0.8%, which is really 9 times greater than the cost of a passive equity mutual fund, a mutual fund that might track the Russell 1000 index. And you could see a similar big differential between the cost for a sample U.S. large cap equity fund versus a sample U.S. large cap value active fund. Now, a couple points to be made here. The cost of active management, of course, is not surprisingly higher than for passive management. After all, when you invest in an active fund, you're buying the skill set of price discovery. You're paying a manager to examine the balance sheet, the discounted cash flows, the management team of individual companies in the S&P 500, whether it's Amazon, Facebook, General Motors, or IBM. Passive manager, of course, does not engage in price discovery. You simply have your assets allocated in proportion to their representation in an index, in line with an index. So no decision making is made. But another point to be made as we kind of get to the systemic impacts is that most experts agree, and arguably passive managers would agree, that the skill set and the function of price discovery, which is performed by active managers, has been an important factor in determining flows of capital to companies, and has been an important foundation for our markets and our economy. And that's one of the reasons that they're concerned. If we have a market where price discovery is less prominent, is not influencing capital flows, might we have a market and an economy that's less efficient? Just going to slide 14, and we're going to move right along here. Another look at some data Maureen already pointed out, the big shift in allocation of assets from passive, or active rather, to passive management. You can see a pretty recent study from Bank of America showing us that on the upper left-hand side, allocation of equities going beyond just mutual funds, I believe, in this particular study, to passive equity strategies in the U.S. Almost doubled from 19 to 37%. And a point to be made here, if you look at the quote at the bottom of page 14 from the Bank of International Settlements, they make the point that as we move to a higher share of passive investors, it raises the question of whether that market discipline, the discipline that causes the board of directors of a company to make sure they have a strong multi-year strategic plan, to make sure they have a strong framework for managing risk that effectively has been enforced by active management, whether or not as we move from a market that previously had almost no assets passively managed to a market where perhaps 50% are passively managed, some of that discipline might be lost. Just going to page 15. Maureen was going to talk about the big shift in ownership and control that has been an unintended consequence of the shift from active to passive management.
Great. So later on in the presentation, we're going to look at the corporate governance and proxy voting impacts from passive managers, and we are going to focus on three firms: BlackRock, Vanguard, and State Street. And the reason we're focusing on them exclusively is because they really are pretty much the entire pie of passively managed assets. They manage about 80% of indexed assets. In the S&P 500, those three firms combined cumulatively are the largest owners of 90% of the S&P 500. And if you extend that out to all U.S. publicly traded companies, they're the largest owners of 40% of those companies.
Okay, we talked about exchange-traded funds being a larger component part of indexed equities in the U.S., and slide 16 just puts an exclamation point behind that statement. If you look on the left-hand side, a study that was published in MarketWatch this past fall showed that over an 11-month period ended in November 2017, really a very impressive $1 trillion of assets were invested in ETFs. So ETF assets, exchange-traded fund assets, increased by 34% over an 11-month period. And as you can see in Exhibit 2 on the right-hand side, going back to the quote from John Bogle, an increasing share of that $4.6 trillion in ETFs is going into index fund ETFs. Ernst & Young is projecting that over 30% of ETFs will be invested in index fund ETFs by 2022. And again, that gets to the concerns around market volatility. Just going to slide 17. Building on Maureen's point about concentrated control of ownership of U.S. equities, because of the concentration of competitors in the index fund industry, we have the same concentration in the ETF industry. If you look at the far right-hand side, Exhibit 2, about 82% of the $2.65 trillion in U.S.-listed ETFs are, again, managed by the same three firms. I want to make a couple of points here. These are very good firms. They're firms who are helping public, non-public pension funds, individual investors achieve their goals. But the question really is, and it's driven home in part by the quote at the bottom of this page from a New York University scholar, is this kind of concentration of control in the hands of three firms, which translates into concentration and control, or at least increased control of U.S. companies, is that a good thing for our economy? We're just not used to that type of concentration, and it does raise some concerns. Maureen will elaborate on that in just a bit. Go to the next slide, which is slide 18. Some other concerns, or back to the point on slide 18 of price discovery or price discernment. When you look at the bottom of page 18, you can see a quote, again, from MarketWatch, same article as I cited just a minute ago on the preceding slide. MarketWatch makes the point that a decade ago, and if you think about it, a decade ago might seem like a long time ago, but it wasn't. just a decade ago, according to MarketWatch, 95% of the flows of equities, that is the investments in the IBMs, the Amazons, the Facebooks of the world, the General Motors of the world, 95% were determined by active manager decisions and were a function of price discovery, which again is all about examining a company, looking at its balance sheet, discounted cash flows, whether it's innovating for the benefit of shareholders. And today, at least according to MarketWatch, that number's down to 77%. And again, it raises the question, if we lose the influence of price discovery as a discipline over corporate America, as a motivator of performance, does that raise some questions? Again, thinking about it, index funds assets are simply flowing to the equities of U.S. publicly traded companies based on one criteria. And that one criteria is the weight that that company represents in the index. Just going to slide 19, the next slide. A couple of points to make before turning it over to Maureen to elaborate really on corporate governance impacts. Market volatility. The New York Times, as you can see from the quote at the bottom of page 19, published an article on February 5th, 2018, in which they reported that on some trading days during the week of, they published the article, on February 9th, but on some trading days during the week of February 5th, 2018, which if folks will remember, that was really the most volatile week we've had in the stock market in several years. At one point during that week, stocks lost 10% of their market value, and the New York Times points out in an article that's really right in line with the presentation Maureen and I are making, that on certain trading days, 38% of trading was driven by index ETFs. And once again, it's not so much indicting or criticizing the concept of indexing. Indexing is a powerful and effective tool, but it's more the use of indexing. And in this case, it's the use of indexing for ETFs, which also have very well documented uses for institutional and individual investors. But in this case, it's investors who are using ETFs to get into and out of indexing, exacerbating the highs and the lows of the markets. And that's something we have to keep an eye on. If we're going to go to slide 20 now.
Great. So there is a few ways that investors can communicate to the publicly traded companies that they own assets in. One is by buying the stock. So we just did a lot of explaining about the difference between passive and active and how those stocks are selected. So if an active manager likes a company, they can buy that stock. Another way that investors communicate to companies is through proxy votes. So whether you're passively invested or actively invested, there are votes being communicated to the company that help directors get elected to the board, that set the compensation policy for a firm, that approves auditors on an annual basis. Investors have these rights. If you're actively managed, the underlying investor has those votes directly. So if you're a public pension fund and you own stocks of Facebook, then you are deciding whether or not Mark Zuckerberg should continue on as chair of that board. You have a direct vote. But when you're passively invested, you cede that proxy voting right to the passive manager. So if you're using BlackRock or State Street, Vanguard, or another firm, that firm takes over that vote and they decide. Now, whether or not that is a concern to you depends on how you look at proxy voting issues and whether you agree with how those votes are being cast. If we look at slide 20, this is just a preliminary slide to give you, back to 20. It's a preliminary slide to give you a flavor of how different firms vote proxies. There are two types of shareholder proposals that become the subject of proxy votes. One is from management. So the management of the company puts on a proposal because they're required to under SEC regulations or because they want to gauge investor sentiment. The other way that a proposal makes it onto a proxy ballot is if a shareholder puts that forward. It's a relatively low bar for a shareholder to put a proposal in, and once they do that, the entire investor base of the company can opine on that issue. If you look at the chart here, I have Segal Marco's proxy votes as a comparison to the passive managers for comparison's sake. On management proposals for the last 2 years, we supported about 64% of proxy votes put forward by management. That means in a lot of cases, we disagree with the nominees up for the board or with how the company is structuring its pay plan or an acquisition, different subjects of proxy votes. Vanguard, State Street, and BlackRock over the past 2 years have supported overwhelmingly management proposals. Vanguard has been the most supportive, only voting against about 3% of the proposals that are put forward by the company. On shareholder proposals, State Street is more aligned with how we view shareholder proposals, so they're supporting roughly a third of them, and that support over the past 2 years has been lower for BlackRock and Vanguard. As we move to slide 21, another lens through which to view proxy votes is to select key votes and to see how different firms are weighing those proxy votes. The AFL-CIO does a key vote survey every year where they select important votes and then they assess how different owners vote on those issues. In 2017, BlackRock supported about 30% of those key votes. And in this case, the AFL-CIO is recommending that shareholders vote in favor of all of the key votes that they list. So you can read that as BlackRock is voting against the recommendation about 70% of the time. You can see the passive managers are not in lockstep on these issues. Their votes do vary. State Street is more supportive, close to 50% of the votes in 2017. 2016, those statistics are a little lower, so BlackRock and Vanguard supported, and State Street supported fewer of those key votes put forward by the AFL-CIO. Moving to slide 22, yep. So another project that Segal Marco undertakes each year is to select key votes that NCPERS members may want to pay attention to. So we select 10 votes to draw attention to the kinds of topics that are put forward for investors to vote on. In 2017, we looked at those key vote survey, and then we assessed how the passive managers voted on those votes. BlackRock supported 33% of them, State Street, same number, and Vanguard supported 44% of them. Moving ahead to slide 23. So I'm going to go through some of these key votes that we had in 2017. The passive managers proxy voting is public record, but there's a lag in the reporting, and so we can't see how they voted in 2018 until 2019, but we do have data from the 2017 votes. So to give you a flavor of how they're coming down on different issues, we're going to go through these key votes. I won't cover all of them in the interest of time, but they're all part of this presentation if you want to go through them. So on slide 23, this is the Wells Fargo Board of Directors vote. So as you probably all heard, Wells Fargo has been a subject of pretty controversial business practices in the last few years. In 2016, there was an accounting scandal where it was found that company employees had opened 2 million fake accounts. It was driven by a culture where sales practices were overly aggressive. The company did agree to have an independent investigation in the fallout from this scandal, and that independent investigation came back and said that the company was run less like a financial institution and more like a sales organization. The company ultimately paid $185 million in fines to settle claims with regulators. And then also they clawed back compensation. This was the clawback provision at the company allows the board to recoup compensation from executives when they're found to have caused reputational harm to Wells Fargo. And that policy came into place because of a 2013 shareholder proposal that was put forward by the New York City pension funds. So because the board had this tool in their tool belt, they were able to utilize that in 2016 when these executives were found to bring reputational harm to the company. The CEO ultimately had to give back $69 million, and the head of community banking gave back $66 million, and neither of them work at Wells Fargo anymore. On the board of directors vote for 2017, we took the approach that the entire board should be turned over. This seemed to be, based on the independent report that came out, it seemed to be a real failure of corporate culture and a lack of oversight from the board. So if you move to slide 24, you can see this is the full list of board members on the column, and Segal Marco opposed the election of those directors. On the circles here, you can see where the 3 passive managers voted. State Street voted against 1 director, and Cynthia Milligan had served on the board of Wells Fargo for 24 years, and that is the only sort of standout feature of her directorship. So interpreting that, State Street probably opposed her election because they thought she was on the board for too long, but they supported the rest of the board. Vanguard voted against 3 members of the board, Enrique Hernandez, Federico Pena, and Steven Sanger. And those 3 directors had different roles at the company. Pena was the financial expert on the audit committee, and Steven Sanger was the chair of the board, so those were easy standouts for votes against. But they supported the remaining board of directors. BlackRock had a more aggressive vote against, so they voted against the 3 directors, Dean, Duke, and Quigley, that are listed there, as well as Milligan and the 3 that Vanguard voted against. Moving on to slide 25. Now, a question that I often get asked is, do proxy votes matter? So you cast these votes, and any individual public pension fund is not going to have enough of a holding in a company to determine the outcome, to really sway it. But proxy votes do get addressed because they are not ignored by companies. If shareholders have a majority vote, the company typically responds, and a weak vote also gets addressed. In the case of Wells Fargo, there were 4 nominees that received less than 60% support for their election. A typical board member that's up for election at a company gets in the mid-90 range of support. So to have that support be at the less than 60% is a really low vote. That said, all 4 passed the 50% hurdle. So technically, none of the directors were kicked off the board in 2017 because the votes against were not high enough to get them off of the board. Even so, because the votes were so low, we saw 7 resignations within the year. So there is a pressure on the directors because they don't have the will of the investor base if they're not getting strong vote support. The directors listed in the middle continued on the board, and there were 4 new directors added in 2018. Moving to slide 26. Further supporting the idea that we need a fresh perspective on the board and that's best brought by a brand new board of directors is that more scandals have come to light at Wells Fargo. There was the accounting scandal in 2016. In September, we had the shareholder vote later that year in the spring of 2017. And then we had a new scandal that broke out in July of 2017 where customers were being sold auto insurance that they didn't need. They were being overcharged for it, and cars were being repossessed unfairly from the company. The company paid $80 million to try to remedy those customers who had spent too much money or had their property repossessed without warrant. The New York State Common Retirement Fund put a proposal in for the 2018 meeting that asked the company to take a look across the entire company and assess whether the sales incentives and sales rewards were causing this misbehavior. That proposal went to a vote. We don't have any data yet on how the passive managers voted on that proposal. We supported it. It got about 20% of the vote. But you can see this corporate culture at Wells Fargo is still in need of change. Moving on to the next slide. At Facebook, there was a proposal back in 2017. This was a key vote on the NCPERS list, asking that shareholders support the company issuing a report on how they were governing their content. Up to that point, Facebook had come out publicly to say because it was not a media company, it didn't have a a requirement to make comments about the content that was on their site. It was just a platform where shareholders could put whatever information they wanted there, and they weren't going to be an arbiter of what was on the site. In 2017, the shareholder proposal asked them to do a report to see where there were flaws in their content management and what they could do better to protect the users of their site, to ward off against fake news, to look at data security. Facebook recommended shareholders vote against that proposal. We supported it. BlackRock, Vanguard, and State Street all voted against this proposal. Mark Zuckerberg stood up at the meeting and said that this wasn't a necessary endeavor. We've seen everything that has happened since that time. The Cambridge Analytica scandal surfaced in this March, and the stock slid about 16%. Initially, Facebook came out and said that data had been compromised from 50 million users, and then a short time later, it came out and said that number was actually 87 users. And because this shareholder proposal did not get majority support, the company was not under pressure to issue the report or to look into this matter any further. And now we're in the situation where Mark Zuckerberg testified in front of a congressional committee and has had to defend himself against how the company controls content on its site. So this is just a good example of how early shareholder proposals can be harbingers of corporate scandals later on if they're not addressed in a very transparent way for investors. Moving on to slide 28. This was a proposal in 2017 that was a key vote at McDonald's. McDonald's, most of its operations have moved from corporate-owned restaurants to franchisee-owned restaurants, and there was a proposal on the ballot to give franchisees a seat at the board. We supported this proposal. The 3 passive managers voted against, and that did not get majority support. So if we move on to slide 29. Julian, did you want to speak about this key vote at Swift Transportation?
Thanks. Actually, I'm going to propose that we keep moving to get you to the other slides you want to cover, Maureen.
Okay, sure. So we'll move on to a new slide, slide 30. This is a proposal on executive compensation. It asks that companies consider pay throughout the organization when they're setting CEO pay. All the companies where the logos are listed on the right-hand column adopted this policy. SL Green was the one holdout where the company didn't want to implement this policy, and so that proposal went to a vote. The 3 passive managers voted against it. We supported the vote, but it did not pass. So we'll skip ahead to slide 32. Great. This is a proposal at Cognex Corporation on board diversity. The proposal asks that the company include diverse nominees in every candidate pool when board election is up. The idea here is that there's been a lot of good research. There's 2 studies cited here that show that if you have a more diverse board, the company tends to outperform. A strategy for creating that more diverse board is to include more nominees in the pool. This has been a policy that is being adopted with more frequency in the last couple of years. Cognex Corporation put that proposal out to a vote. Vanguard supported it. State Street and BlackRock voted against. If we move down to slide 34. This is a proxy access proposal at IBM. Proxy access is the ability of shareholders to nominate a candidate for the board. This is a proposal that BlackRock, State Street, and Vanguard used to oppose, but there's been a lot of work, particularly by the New York City pension funds, to engage the passive managers in urging their support for these proposals, because there's been good research that shows if this was adopted market-wide, the market cap of the U.S. Equity market would raise by $140 billion. So this is one example of a vote where everyone had consensus. The 3 passive managers voted in favor of it. We voted in favor of it as well, and it passed, which means the company has implemented it. Moving on to the next slide. This is a list of the key votes for 2018 that we put forward to NCPERS members. As I mentioned at the top of the call, we don't have the data on this yet, but these would be votes to pay attention to in 2018. Moving on to the next slide. So there are a few pie charts in the next few slides, and this is more data on how the three passive managers are assessing a particular subset of proxy votes, which is workforce diversity and pay parity, the idea that you should be paid equally for equal work, regardless of gender. You can see as from 2015 to 2016 to 2017, there's been progressively more support, but the majority of proposals are still voted against. And these are the votes by the three big passive managers, BlackRock, State Street, and Vanguard. Next slide, Hank. This is BlackRock. So it supported 24 proposals in this category in 2015, and their support has pretty dramatically increased. In 2017, they were supporting more than 900 of these votes. Next slide. This is State Street Global Advisors. So from 2015 to 2016, there was a big swing and more support. 2016 to 2017, their support levels stayed relatively stable. And then next slide. This is Vanguard. Vanguard used to use the abstain vote more aggressively. So in 2015, they voted to abstain on 546 of these proposals. They have since changed their voting dynamics, and so in 2017 they had no abstain votes, but they voted in favor of 642 of these proposals. Moving on to slide 40. These are proposals that received majority votes. There's within this category of workforce diversity and pay parity. So you can see not very many of these proposals get majority vote, and these are from 2017 and 2016. So we'll move now to the next slide, and I'll pass it over to Julian to summarize our takeaways.
Thanks a lot, Maureen. I think we just want to leave enough time for questions. Again, I think the takeaway is really a very significant change in our equity markets, impacting concentration and ownership of control of U.S. companies, as evidenced by Maureen's presentation on corporate governance. And questions about how our economy and our market are going to behave going forward. A lot of folks are looking at this question. The stakes are pretty high, and we'll be continuing to study and report on this going forward. But I think at this point, we'd open it up for questions and appreciate the time.
Great. Thank you, Maureen. Thank you, Julian. So in terms of questions, it's been recorded that Larry Fink, CEO of BlackRock, wrote an op-ed in the Wall Street Journal on ESG. What was? Are you aware of it? And where is BlackRock essentially in terms of support of ESG?
So I'll take that, Julian.
Absolutely.
Okay. So so BlackRock, I am aware of it. It was lauding ESG. Larry Fink said that companies needed to do more than just have good financial metrics. They needed to be active in the ESG space. BlackRock will report that it has conversations with companies about ESG regularly. As a public member or a public investor, we're not privy to those conversations, so we can't really tell what's going on behind closed doors. One thing that is public is BlackRock's voting record. So you can look at ESG data and see if BlackRock is supportive. And they haven't really been that supportive of ESG proposals in their proxy voting record. It's starting to change a little bit, as you can see from the pie chart that I had earlier in the presentation. But that is one indicator of what it's doing.
Why are some academics concerned about the impact of indexing on corporate performance?
I'll take that one if you don't mind, Maureen. In answer to that question, the concern is this. Let's take the hypothetical board of directors of Corporation A. 4 decades ago, that board of directors knew that every nickel that was being invested in the stock that they issued was being invested in that stock based on somebody evaluating the strength of their company, the strength of their management, the strength of their decision making. So as a governance body who's motivated to increase shareholder value, they were highly motivated to perform because they know capital is flowing to their company based on performance, and it will not flow to their company if they have poor performance. If you move to a world where 50% of capital flows, this is a hypothetical, of course, but it matches the Moody's prediction. So if we have a world in 2024 where the same board of directors knows that 50% of the capital, 50% of the money that's being invested in their stock is going to go there anyway. It's simply going to be invested based on their index weight. If they're Amazon, if they're Apple, they're a 3% plus weight in the Russell 1000. They're going to get that capital, notwithstanding the decisions they make on the balance sheet, notwithstanding whether they make good decisions on disposing of assets, notwithstanding whether they innovate. The money's coming anyway. And so that's the answer. I hope it's a satisfactory one, is that you now have an incentive that, if not eliminated, it's diminished, and that could result in underperformance of U.S. companies, and what that would mean would be underperformance of our U.S. economy that creates so many jobs and enhances shareholder value.
So I'll throw this last question out as moderator and as my prerogative. So Julian, Maureen, you both referenced prior partnerships that NCPERS and Segal Marco have had over the years. Certainly that we've done the model proxy voting in the past, as well as more recently proxy votes to look out for. You know, with the change in the market and more going into passive, what are the things that we should be partnering on going forward?
Maureen, want to?
Yeah. So I think in terms of the passive versus active debate, you can still influence proxy votes either way. With active managers, where the pension fund owns the stock and they can cast votes, you should know how those votes are being cast. NCPERS members should be aware of that. They should be asking their managers how those votes are being cast. They should understand the issues, and managers should be able to explain what their philosophy is and what they're trying to achieve at companies with those votes. And the same really goes for passive managers. So even if any state pension fund can't make the particular vote, you can still ask your passive managers, how are you voting on these issues? Is that the right idea? I mean, the concern really is that for the passive managers, their client base is pretty widespread. So they may in fact they may have a corporate defined benefit plan in the same index fund that they have a public pension plan in. And when they're voting for the CEO compensation of a company that maybe they have an invested stake in, it just muddies the waters a bit. So it's good for public pension funds to speak up, to explain to their passive managers what they think is in their plan participants' interest, so that they have a seat at the table as well.
Maureen, if I could just add one point very quickly. I think, Hank, that working together to study the structure of ownership and control of the U.S. markets, because going back to, of course, this is what NCPERS is all about. Public pension funds are powerful owners, influential owners for the better of the U.S. equity markets, and to the extent that the structure of the markets are changing, we need to work together with all stakeholders to make sure that public pension funds are taking action to ensure that their record of leadership continues even in a changing market. That can involve looking at data. That can involve listening to some arguments I've heard from at least one academic who's made the case that if you delegate your investment, if you make investments in commingled funds, you should still have a voice in proxy voting. So I really think looking at the structure of the markets and making sure that public funds continue to maximize for the greater good their role as one of the biggest owners of corporate America is something we can work on. It's something we have to work on because we know the structure of the markets is changing pretty significantly, so we have to solve for that.
Well, Julian, Maureen, thank you so much for this great presentation. To the audience, at the conclusion of this webinar, there will be 3 short survey questions that we ask you to answer. And we look forward to hosting you again at the next NCPERS webinar, which will be on July 19th, our semi-annual review of legislative activity at the federal and state level. Thank you so much.
Thank you.